Hello, everyone, and welcome to our first lecture series on very exciting subject, which is financial accounting or principles of accounting. And I'm your instructor, Jamal Haider. So, to begin with, the preferred course book that I have selected is from Pearson, and we're gonna be covering some chapters uh, from 10th edition by Harrison et al. So don't worry, you don't need to purchase that book, and I will be, uploading the book chapters on our WeChat discussion forum and our Blackboard discussion forum as well. Okay, to begin with, so regarding the exam policy, so I have designed this course as 40% assignment, 30% midterm, and 30% final. So your total evaluation, if you notice that the big portion is assignment. So pay close attention to the assignment's requirement and respect the due dates. So I have no problem to give you 40%. Okay, let's move further. So if you are ready, then let's begin. Okay, today we will be starting our first chapter, financial statements. So this chapter addresses the financial statements, which are the business documents that companies use to report to the results reports the results of their activities to various groups of users. So these users group can be managers, investors, creditors, or government controlled agencies as well. So in turn, these parties use the reported information to make a variety of decisions, such as whether to invest in or loan the money to the company. To learn accounting, you must learn to focus on decisions. So, to begin with, our first learning objective is explain why accounting is the language of business. So, to explain that, why accounting is the language of business, so accounting is an information system. It measures business activities, process data into reports, and communicate results to the decision makers. So, the better you understand the language, the better you can manage your finances as well as those of your business as well. So, accounting produces financial statements which report information about a business entity. So, the financial statements measure performance and communicate where a business stands in financial terms. So, this diagram basically illustrates the flow of accounting information and helps to illustrate accounting rules in the business. So the accounting process begins and ends with the people making decisions. So here, people make decisions. When they make decisions, business transaction occurs, and those transactions are gathered or produced in reports. So companies publish their reports for the users. And what kind of users are? We have managers, we have creditors, we have customers, we have government agencies, and they also use those results to make decisions. So this is how the flow of accounting information works. So now question arises, who uses accounting information? So number one, individuals. So individuals also use accounting information when when they manage personal bank accounts, when they decide whether to rent or buy a house or a car or whatsoever, or when they budget monthly income and expenditures. So accounting provides necessary information to allow individuals to make decisions. The second one is investors. So investors and creditors provide the money to finance the businesses. So investors want to know how much they can earn on an investment, while the creditors they want to know when they are going to be paid. So how they are using the information in decision making to answer those questions, they are already using the accounting information. So number third is, and the third one is the regulatory bodies, which is all kind of regulatory bodies like IRS and SEC. They also use accounting information in decision making. So IRS requires business, individuals, and other organizations to pay taxes. So accounting information is used here because individuals they earn money, right, and they have to pay taxes. Businesses they earn profits, and you have to provide the information, and they look for that how much you are required to pay taxes. Similarly, the Security and Exchange Commission, it requires public companies to provide financial reports. When they provide financial reports, so they are also using the accounting information. The fourth one who uses the accounting information is the non-profit organization. So non-profit organizations such as the hospital, churches, the charities like Red Cross, so they base many of their operating decisions on accounting data. It means they are using accounting information. Plus, these organizations have to file periodic reports with the IRS and the state governments. So both external and internal users of accounting information exist. So we can therefore classify accounting into two branches. One is financial accounting and one is managerial accounting. So the financial accounting provides information for decision makers outside the entity, such as investors, creditors, government agencies, and the public. While the managerial accounting, it provides information for the managers of a business. For example, management accounting information include budgets, forecast, projection. A key or subtle difference between financial accounting and managerial accounting is that the users of financial accounting are outsiders, and the users of managerial accounting they are insiders. So organizing a business accounting is used in every type of business. Generally, businesses are organized in one of the following form. Number one is proprietorship. Number two is partnership. Number three is limited liability company. Number four is corporations. So I hope you already studied in the introduction of business, but just we're gonna look a different or accounting perspective of these form of business. So let's see one by one. So let's talk about the proprietorship. So in proprietorship, there is a single owner, which is also called proprietor. So proprietorship tend to be small retail stores or solo providers of the professional services like haircutting salon, or the nail artist, beauty salon. So small beauty salons, or like near our Donghua University, there is Lanjo Lamian. So these are called proprietorship. So the tagline here is that the proprietor is personally liable for all the business debts. What does it mean? It means if there is a loss and that cannot be covered through his business, then loss is going to be fulfilled through his personal wealth. which means if he has to sell his house, his car, and valuable stuff, and then he must sell his personal property to cover the loss. The last point is that for accounting purposes, proprietorship is a distinct entity, which means ownership, owner is separate and business is separate. So, thus, the business record should not include the proprietor's personal finances, which means business statements. It does not include that how much the proprietor has in its personal account, and what is the cost of its, luxury car, or what is the cost of his house, and etc. The next one is partnership. So partnership has two or more parties as co-owners, and each owner is a partner. So individuals, corporations, partnerships, or other types of entities can be partners. And income and loss of the partnership, it flows through to the partners, and they recognize its based on their agreed upon percentage interest in the business. For example, if loss occurs, 20% share is loss is shared by A, 80% loss is shared by B. So, but the question is, even if there is a 20% loss, and by selling A's personal wealth, A can only afford to fulfill 10% loss, then the liability would be transferred to B, then B would be covering 90% loss, because this is a partnership, and both and partnerships are partnership has unlimited liability. So partnerships, it may include the retail establishments, professional services, firms, real estate, oil and gas exploration companies. So general partnerships have mutual agency and unlimited liability, which I just mentioned you here with this point. What does it mean by unlimited liability? So in order to minimize this proportion or this concept, that one partner can say that it's not my fault, I am a good partner, I am fulfilling my responsibility to the best faithful manner, but it is because of the other partners and I'm sharing the loss. So it's better that you establish the limited liability partnership, which lessens the risk to other partners or partners as well. So it means if the loss has occurred, then only the amount you have invested in the partnership, that will be lost. So it means no personal property is involved in limited liability partnership case. Okay. The next one or third one is limited liability company. So a limited liability company is one in which the businesses is liable for the company's debt. It means the members of the limited liability company, they are not responsible for fulfilling the company's loss. So the business is responsible for fulfilling the company's loss. If business cannot fulfill the whole loss, then loss is not transferred to members' personal wealth. So, the limited liability company, it has one or many owners. We call that members, and members have limited liabilities. So, for taxation purposes, so it is taxed like partnership. So it means income that are generated by the business will be included in the income of members, and member is taxed according to its tax slab rate.